Question 41. ABC Company's oldest goods purchased are sold first, and the newest goods purchased remain in the ending inventory. This is an example of LIFO, FIFO, or weighted average cost method. So, oldest goods sold first, newest goods remain in the ending inventory. LIFO would be newest goods purchased are sold first, so we can rule that out. FIFO would be oldest goods purchased are sold first, so that's probably going to be our answer. C, weighted average cost method, that's going to be averaging the cost of the goods in the inventory, so timing of oldest and newest isn't really as relevant, but it doesn't say anything about averaging the cost of what's sold or what's remaining. So we're going to go with B, FIFO. Question 42. Baskin Ice Cream's net income for the year ended 31st of December 2016 was USD 1.75 million. The following are the details of the common stock of the company. So we've got some details here on shares outstanding and then when shares were repurchased or issued out throughout the year. The company declared and paid USD 450,000 dividends on preferred stock. What is the company's weighted average number of shares outstanding? So what we're going to be doing here is we just need to figure out how many shares the company had throughout the year and then weight that in order to get that weighted average number. So how this is going to kind of work is, so from January 1st until May 1st, so that's 4 months, we'll have 96,000 shares. So that'll get a weighting of 4 months over 12. And then when we're repurchasing shares, that's going to be subtracting from our amount of shares. So from May 1st to August 1st, we're only going to have 80,000 shares. So that 3 months is going to get 80,000 shares, and it'll be weighted by 3 over 12. Issued is going to add to our share count, so we'll go up to 120, and that'll be for a 3-month period from August to November. And then we issued more, so we'll be at 126 for that last period. And so pulling in our answer here, we can see exactly that we walked through. And then when we add all these up, you'll see that we get 103,000, so we'll go with answer B. Question 43. Which of the following statements is or are true with regard to reporting of property, plant, and equipment by companies? We've got 1, 2, and 3 here, and then we've got answers 1 only, 1 and 2 only, or 1 and 3 only. So we'll take a look at 1 just to kind of talk through it, but since we know that, since 1 is in every answer, we know that statement's going to be true, so we can really focus on 2 or 3 for purposes of answering the question. So we'll start there first. So 2, reversals of impairment losses are permitted under U.S. GAAP. This is true under IFRS and not under GAAP, so we can cross out answer B here. So we'll just give this a X. And then we go to 3, IFRS allow a company to use the cost model for some classes of assets and the revaluation model for others. But the company must apply the same model to all assets within a particular class of assets. This is true, and so since our answers are either 1 only or 1 and 3 left, we are going to go with C as correct. So for A, IFRS permits companies to report PPE using either cost model or revaluation model. US GAAP permits only the cost model for reporting PPE. This is also true, and I would say this applies to all 3 of these answers really. As a general rule of thumb, if you can't memorize every single rule, IFRS is generally going to be a little bit more flexible in how they let the companies report So if we kind of use that as a guiding point, I think that would still bring us to the right answer here, just because we can see on one, IFRS is permitting an option. Under 2, US GAAP is less flexible, so they're not going to allow those reversals of impairment losses. And for 3, kind of same thing, it's allowing a more flexible model. So yeah, long-winded way to kind of get to answer C. Question 44. When prices are rising, the value of ending inventory is the highest under FIFO, LIFO, or weighted average cost method. So we want to think about the prices and basically what we're going to be holding at the end of the period. So prices rising under FIFO stands for first in, first out. So we're going to be selling the inventory that we bought first at the beginning of the period, and so it tells us prices are rising. So that means the value of what we're going to be holding is the stuff we bought at the end of the period when prices were higher. So this is probably going to be our answer, but let's go ahead and just rule out B and C. So for LIFO, we're going to be selling those higher value inventory if prices are rising. So it's last in, first out. So inventory bought towards the end of the period at higher prices is going to be sold first. So what we're going to be showing on our books is the price of the inventory at the beginning of the period when those prices were lower. So it's going to be lower ending value than FIFO. So we can rule that one out. And then for C, it's going to be weighted. We're weighting the average cost and that of all inventory bought during the period, and then we're using that as what we take as our value. So if prices were lower in the beginning of the period but higher in the end, we're going to get some number in the middle. So it's going to be a higher number than LIFO but lower number than FIFO. So we will go with answer A. Question 45. XYZ Equipment Limited has made the following inventory purchases during the first quarter of 2017. We've got our purchases and information number here, number of units, price per unit. During the quarter, the company sold 200 units at GBP 50 per unit. The company had 5 units of inventory at the cost of GBP 49 per unit on hand at the beginning of the quarter. The company had 93 units at the end of the quarter and specifically identifies that 86 of those were procured in March. Assuming FIFO methods, what is the gross profit of the company during the first quarter of 2017? So our gross profit, first off, is just going to be revenue minus cost of goods sold. So let's pull in our numbers here. So our revenue is going to be pretty simple here. It's just going to be those 200 units sold multiplied by the 50 per unit gives us 10,000. Cost of goods sold is where this gets a little tricky, mainly because they kind of slip in here. The company had 5 units of inventory at the cost of 49 per unit at the beginning of the quarter. So this isn't showing up in this chart here. So it could have been easy to kind of assign to miss out on using those. And so since we are using FIFO, we need to use up those 5 units of inventory first. So that's going to be this number here, that 5 times 49. That'll be the first units that we're going to account for in what we sold. So now we're down to 195 units left that we need to account for. So we've got 108 from January. So we're going to take that whole group, since it's less than the 195 number, and we're going to multiply that by the 45 to get additional cost of goods, to get the cost of goods sold of the inventory from that period. And then so now we went from 195 down to 87 left after we take that 108 out. So since February, we've got 94 left. We'll take the remaining 87 out of here. So we've got 87 times 48 per unit. We can see right here. Multiply all these out, add them together, and we get 9281. And then it's simply just going to be the revenue minus the cost of goods sold. Gives us our final answer of 719B. Question 46. Which of the following is least likely a reason for a firm to overstate its net income? A, to minimize incentive compensation, B, to meet analysts' earning expectations, or C, to remain in compliance with lending contracts. So we really want to understand which of these would really have negative consequences if our income was lower. So the incentives to overstate it are high. So we'll start with C, to remain in compliance with lending contracts. There's certainly a reason to overstate here, just because breaking a lending contract or becoming out of compliance with that could lead to default, which could be detrimental to the company, or maybe it doesn't lead to default, but it could lead to potentially higher borrowing costs if the company's earnings are not keeping up and they're becoming more of a default risk. So I think we can rule out that answer. Certainly an incentive there to overstate net income. B, to meet analyst earnings expectations. This one, there's also going to be a bad incentive here to overstate net income. If you don't hit expectations, a lot of times your stock price is going to suffer and Wall Street won't like you. So we can rule out B here. So our answer is probably going to be A, and I think it definitely makes the most sense. To minimize incentive compensation, if you're overstating your net income, you're probably giving out greater incentive compensation because your executives may make more money if their divisions or sales are more profitable and whatnot. So if you wanted to minimize incentive compensation, you'd probably want to understate net income. So we'll go with answer A. Question 47. Thermax Steel Company had a weighted average of 60,000 shares of common stock outstanding. The company has only one potentially dilutive security, USD 25,000 of 4% convertible bonds, convertible into a total of 5,000 shares. The company reported a net income of 100,000 for the year, ended on June 30th, 2016. Tax rate is 30,000. The diluted EPS of the company is closest to. So I'm going to bring in our diluted EPS formula first. So we're going to be looking at our net income over total number of shares if the dilutive securities are converted. So our net income is going to be that 100,000. That's the easy portion of that. And then total number of shares if converted, we're going to be taking that 60 in the beginning, and then we'll add the 5,000 to get 65,000 here in the denominator. The little trickier part on the net income comes in is you're paying interest on these convertible bonds. And so if they get converted, you're no longer having to pay. They're now equity stakes, and so you're not paying that 4% on 25,000. So the additional income you have after tax, we're going to take that 25,000 times the 4%, which gives us $1,000 of interest that we're paying, and then tax rate's 30%. So we'll still lose out on 30% of that. But basically, we end up getting additional net income of $700. So we pull all that in, gives us our answer. We've got that 100,000 plus the 700 divided by the 65,000. Like we said earlier, we get 1.5492, round up, and we get answer A. Question 48. On June 1st, 2017, Wall Street Journal received a cash payment of $1,000 USD for a 2-year subscription to the monthly journal. This transaction would most likely result in which of the following on June 1st, 2017? We've got A, cash increased by 1,000 and income increased by 1,000. B, cash increased by 1,000 and unearned fees increased by 1,000. Or C, cash increased by 1,000, unearned fees increased by 500, and income increased by USD 500. So this is gonna when we're receiving cash this far in advance for services that we are to be providing, which is implied by receiving that cash payment for a 2-year subscription to a monthly journal. So we're providing our services monthly over this long 2-year period. So this is going to create unearned fees because revenue has to be recognized at time of actually providing the service. So this 1,000 will go into unearned fees since it's on the day. We're talking about what happens on the day of the transaction. So on the day of the transaction, we're not providing any service technically until we send out that first journal. So that whole $1,000 is going to go into unearned fees, but our cash is going to increase by 1,000 because we're receiving a cash payment. So we're going to go with answer B. So answer A is obviously not correct because it would be recognizing all that revenue up front here, which is not proper practice. And then C also wouldn't be correct because it's increasing income by half, but we haven't provided any of the services yet, so we can't do that. So we'll go with B. Question 49. ABC Corp is a large publicly traded company. At the end of the auditor's report, the auditor most likely provides A, assurance that financial statements are fairly presented, B, no assurance that financial statements are fairly presented, or C, reasonable assurance that financial statements are fairly presented. So looking at A and C answers here first, we can see the only difference in the wording is that reasonable number. So for that reason, we would probably go with C over A, since auditors are typically taking a sample of the financials and then testing that way. So adding in that reasonable assurance number kind of covers them since they can't provide full assurance without looking at the whole of the financial statements. So they're just taking a sample. So for that reason, we'll go ahead and cross out A, and let's take a look at B. So B, saying that no assurance that the financial statements are fairly presented, this is going to indicate material departure from the accounting standards. And since ABC is a large publicly traded company, they've probably been public for a while and doing this and have a complex staff of accountants on their team, we're going to say that they probably wouldn't provide no assurance that the statements are fairly presented. So we're going to go with C, reasonable assurance. Question 50. Baskin Ice Cream's net income for the year ended December 31st, 2016 was USD 1.75 million. The following are the details of the common stock of the company. So we just have shares outstanding in the beginning and then repurchases and issued to kind of get us to what the share outstanding was at the end of the year. The company declared a 3-for-1 stock split on March 1st, 2016, which took effect on October 1st, 2016. If the company declared and paid a USD $450,000 dividend on preferred stock, the company's basic EPS is closest to. So we'll pull in the basic EPS formula here first. So we've got our net income minus the preferred dividends. So that'll be pretty easy. We'll pull this right out of here. So we've got a net income of 1.75 USD, preferred dividends of 450,000. And then the more difficult thing here, we're going to need to have the weighted average number of shares. So when we're, let me just pull this in here. So basically to get the weighted average number of shares without accounting for the stock split, we're going to be going through this table and weighting the number of shares. And they do everything on the first of the month to make everything a little easier for you. So we're going to have 96,000 shares for the first 4 months here. So we weight that 4 over 12. And then we're repurchasing 16,000 shares. So that brings us down to 80 for 3 months. And then at the end of that 3-month period, we're issuing 40 more. So that brings us up to 30. that brings us up to 120, which we're waiting at 3 months as well. And then we've got issuing 6,000 more for the last 2 months. We've got 126 for 2 months. So we add all this up and we get 103,000. So then basically to account for that stock split, we're just going to multiply that 103,000 by the weighted average number of shares that we had in order to account for that stock split, which is going to be 103,000 we mentioned times 3 is going to give us 309. And then what we talked about earlier, the net income minus preferred dividends, pulling those two numbers in gives us a basic EPS of 421.